repurchases, some of the mechanics of dividends, and some comparisons of repurchases to paying cash dividends. So what types of dividends do we have? Well, if we're talking about cash dividend payments to common shareholders, we really distinguish three types. Regular dividends, this is when the board of directors declares their regular quarterly dividend. We could have a special dividend if the firm has accumulated a lot of cash and they want to return some of that cash to equity holders, but they don't want to signal that they're going to pay this amount on and on and on. They designate that a special dividend. And then a liquidating dividend is return of cash to the shareholders in the event of liquidation of the company. Now, we can also have stock dividends. Now, stock dividends don't pay any cash. They pay additional shares. So, for example, if there's a 10% stock dividend and you own 100 shares, you'll get 10 more shares. A stock split is a little bigger than a stock dividend. It's a proportionate increase. It could be 3 shares for every 2 you own, which would turn 100 into 150, or a 2-for-1 stock split. You'd end up with 200 shares for every 100 that you originally owned. And stock splits can go in reverse as well. A reverse stock split decreases the number of shares outstanding. This often happens if the price of shares gets down too low and it's violating the exchange rules for the pricing of shares. They could have a reverse split. And then in that case, your 100 shares with a 5-for-1 reverse split, or 1 for 5, I guess we'd say, would turn 100 shares into 20 shares. Now note that stock splits and stock dividends don't change the value of the stock outstanding. If I've got a firm and there's 1 million shares outstanding, and I decide, well, let's make that 2 million shares. Well, those 2 million shares still own the equity of the firm, and it's still worth the same thing. So if we double the numbers of shares, the price falls approximately in half. Now, what are the effects on the financial ratios of these? Well, if we pay a cash dividend, then cash goes down. If cash goes down, assets go down. Assets minus liabilities is equity, so equity goes down. And what goes down? Well, retained earnings. The earnings that we've paid out as dividends are not earnings we've retained and reinvested in the company. So our liquidity ratios decrease due to this decrease in cash, which is part of our numerator for our liquidity ratios. And our leverage ratios increase because we've had a decrease in assets and a decrease in equity. So debt to equity would go up and debt to assets would go up. Stock dividends and stock splits, they don't affect any of these liquidity ratios or leverage ratios. Now let's look at the mechanics of dividend payment. Once the board of directors approves the dividend and they announce it, that's our declaration date. That's the date that the dividend is declared. And when they declare it, they say when the holder of record date is, when the payment date is, and how much it is. So what's this holder of record date? Well, since the stocks trade every day, we've got to pick one day and say, well, if you own it on this day, you get the dividend. Everybody who owned it on this day gets the dividend. So in our example here, that's going to be September 17th. And the payment date can be any period away. It's usually fairly close to that. Here we have it on September 30th. So that's the date the payment's going to be credited to your account or mailed out. The ex-dividend date, that's not something they announce, but we can figure it out based on how stocks settle. So if we're saying that if you bought it on the 14th, then you would own it on the 17th. So a regular settlement of 3-day settlement. Then we would say this firm goes ex-dividend on September 15th. Now, I'm assuming there's no weekends in here because these settlement dates are traded in terms of dates that the exchanges and banks are open. So you must own it on the 17th to receive the dividend. With regular settlement, you must purchase it on the 14th so that that trade settles on the 17th and you'd get the dividend. So we define that ex-dividend date as the first date where you can buy the stock and not get the dividend. So between the 14th and the 15th, this stock value is going to fall by approximately the amount of the dividend. Because on the 14th you get a share plus you get the dividend. You buy it on the 15th, you get the share, but you don't get the dividend. Now, another way to return money to shareholders is through share repurchases. And they've increased in popularity greatly over the last decade or so. In an open market repurchase, the firm just goes in and buys shares at the market price. This gives them flexibility and timing to do it when they feel like it. Another way to repurchase shares is through a tender offer. And in this case, they say the company says, well, we'll buy a fixed number of shares. We'll buy 10,000 shares at $40 a share. And this is typically at a little premium to the market. So maybe the shares are trading at 39 or 38.5, and they make a tender offer to buy shares at 40. If there's more shares tendered than they agreed to buy, then they do it proportionately. They'll buy part of the shares from all the people that responded to the tender offer that they would sell their shares at that price. Another way to repurchase shares is through direct negotiation. That is, if there's a large holder out there, the company can talk to that large holder and talk about buying back their shares specifically. And typically this is negotiated at some premium to the current market price. So why do they repurchase shares instead of issuing cash dividends? Well, one, there may be a tax advantage to shareholders. If the tax rate on capital gains is less than the tax rate on dividends, then this is a more tax-efficient way to return money to shareholders. The other thing share repurchases do is they send a signal to shareholders that management believes the shares are undervalued. The management of a company sees their shares trading at what they think is a very attractive price, then it makes sense for them to buy those shares at that price. So let's first evaluate the effects of a share repurchase when the firm borrows funds. If the price of the stock is $50 a share, there's 50,000 shares outstanding. We've got earnings per share of $4 and an after-tax cost of funds of 10%. So if we buy back 5,000 shares, our interest cost is going to be 5,000 shares times the $50 a share times the 10%. So that's $25,000 a year in interest costs on these borrowed funds. So now let's just calculate our new earnings per share. Well, we had earnings of $4 a share on 50,000 shares. So we had 200,000 in earnings. And now we're going to subtract from that this interest cost that we have to pay annually on the borrowed funds. So that's our new net income. In the denominator, we want the number of shares. Well, there were 50,000 outstanding, and we bought back 5,000 of them. So we divide by 45,000 and get earnings per share of $3.89. So the earnings per share fell. Now, the intuition of this is straightforward. We've got something here in this box called earnings yield. Our earnings per share were $4 a share. Our share price, $50. So our earnings yield was 8%. Well, we're paying more than our earnings yield on this borrowed money to repurchase shares. That's why our earnings per share decreased. If that after-tax cost of the borrowed funds is less than the earnings yield, then our earnings per share would have increased. We'd basically be substituting debt for equity. And if our cost of debt after tax is less than our cost of equity after tax, then we're going to have an improvement in our earnings per share. Now let's look at share repurchase effects on book value per share. Again, we've got a price of $50 a share and 50,000 shares outstanding. Our book value per share is $40, and we're going to buy back 5,000 shares. Well, we're spending $250,000 buying this back. Our original equity was $2 million. But after the share repurchase, our equity falls. We're assuming we're using our cash here. I guess we could do it with borrowed money too. Yeah, either way is going to decrease our equity. So our equity decreases by $250,000. Our share base decreases by $5,000. And we get $38.89 a share. So our book value per share has fallen. Now again, the intuition's very straightforward. If we pay more than book value per share, our book value per share is going to fall as a result of the repurchase. We're paying $50 a share, the book value is $40. If we buy shares back for less than the book value per share, then that's going to increase the book value per share of our remaining shares. So, how do we compare the two? Well, if the tax treatment and the information effects are the same, so there's no difference in the way dividends and capital gains are taxed, and there's no differential information effects of declaring a cash dividend versus announcing a repurchase, then the effects are the same. Take a look at an example here with a stock price of 30 and 10,000 shares outstanding. We want to decide, well, what's the difference between paying a $3 a share cash dividend for $30,000 or spending that $30,000 to repurchase shares? Well, we'll see no matter which way we do this, and it's pretty straightforward. The remaining value of the shares is the same. Why? We've returned $30,000. That's all that went on. So if we look at the cash dividend, the stock price is going to fall to $27 if we pay a $3 a share dividend. And the market value of our equity be $270,000. If we repurchased 1,000 shares for $30,000, shares outstanding decreased to 9,000. And now the market value of our equity is $270,000. So the market value of the equity has decreased by the amount of cash that went out in either case. Now one last point I want to cover. We looked at repurchases using borrowed funds. What if we used surplus cash rather than borrowed funds? Well, typically, the cost to us in terms of opportunity cost would just be the interest foregone on that cash or cash equivalents that we're holding. So that would typically be below the earnings yield. And so then we would get an increase in our earnings per share.